Welcome to Talk Tickers. You're here for the shortcut to understanding the crucial insights from today's earnings calls.
And today, we're diving straight into the Sweetgreen first quarter 2025 call.
Yeah, our mission, to pull out the key financial numbers, decode their strategic moves, and figure out what it all means for where the company's headed.
Okay, so let's start with the results. Sweetgreen's first quarter, it was, well, a bit of a mixed bag.
How so?
Total revenue climbed to $166.3 million.
Yeah.
That's up from $157.9 million this time last year. So growth there.
Okay, positive top line.
But digging a bit deeper, same-store sales actually dipped by 3.1%.
Oh, okay, so existing stores aren't pulling their weight as much.
Well, it's complicated. That 3.1% decline includes a 3.4% positive impact from price increases.
Right.
But that was wiped out by a 6.5% negative impact from, fewer people coming in and maybe buying less expensive items. Traffic and mix, basically.
Gotcha. So prices up, but traffic and what people are buying dragged it down overall.
Exactly. But what's fascinating, though, is that over half of their markets still saw same-store sales growth.
Really? Which ones?
Yeah, particularly strong, like double-digit growth in places like the Upper Midwest, Texas, and Colorado.
Interesting geographical split, then.
Definitely. And the average unit volume, the revenue per restaurant for the quarter landed at $2.9 million. They also opened 5 new spots.
Bringing the total to
251 locations by the end of Q1.
Okay, so revenue's up overall, helped by those new stores and price hikes. But there's some softness in existing store traffic. That regional strength is definitely something to watch.
Absolutely. And the company pointed to some reasons for that same-store sales pressure, external stuff.
Like what?
Things like the way the holidays fell this year compared to last, that shifted things.
Okay.
Plus, the LA wildfires had an impact, and just some generally bad weather across several regions.
Right. Those things you can't really control.
No. And looking into April, they also mentioned sales trends are a bit soft. They think it reflects, a wider consumer slowdown.
Affecting specific areas.
Yeah, particularly noticeable in their big markets. Think New York, Boston, Los Angeles.
Okay. Makes sense. So those are tough headwinds. How did all this translate to their profitability, the bottom line?
Right. So the restaurant level profit margin was 17.9% for the quarter.
And how does that compare?
Just a tiny bit down from 18.1% in Q1 last year. So pretty stable.
Okay.
But in actual dollars, their restaurant level profit hit $29.7 million. That's actually up 4% compared to last year.
So margins slightly down, but profit dollars up. How'd they manage costs?
They did see some good news there. Food, beverage, and packaging costs came in at 26.5% of revenue.
Which is
quite a bit better, over a full percentage point improvement year over year.
What drove that?
They credited savings in distribution and getting better prices on ingredients. Favorable pricing.
Nice. What about labor? Always a big one.
Labor and related expenses stayed pretty consistent, 28.9% of revenue, so no big change there.
Okay. And overall profitability, adjusted EBITDA.
Adjusted EBITDA was $300,000 for the quarter. So just positive. And they're maintaining a strong cash balance, $184 million.
Right. So it sounds like they're doing a decent job managing costs, especially food and packaging, which is, crucial when sales are a bit bumpy.
Exactly.
So what's the plan then? What's their strategy to navigate these choppy waters and, boost that growth?
They laid out 3 key strategic pillars for 2025.
Okay. Pillar number 1.
First, they want to, and this is their phrase, revolutionize fast food through menu and technology innovation.
Big goal. What does that mean practically?
Well, a big piece was launching their Ripple fries nationwide back in March.
Ah, yes, the fries. How did those do?
They said it actually helped same-store sales in March. And apparently it's become their most attached side item, which, helps bump up the average ticket size.
Makes sense. Fries are popular. What else on the menu front?
They've got an interesting collaboration coming up with Korean Steakhouse.
Right.
Yeah. Launching a limited-time Korean barbecue-inspired menu. Think KBBQ glazed steak, cucumber kimchi, launching nationwide mid-May.
Trying to create some buzz, attract maybe some new folks.
Exactly. Attract new and returning customers. And beyond that big launch, they're planning more seasonal menus for summer and fall. And also looking at refining how they prepare their core ingredients, just elevating the basics.
Okay, so menu innovation is key. Ripple fries seem like a smart addition, and that KBBQ sound like it could draw attention. What's pillar number 2?
Pillar 2 is about strengthening guest connection and operational excellence.
Guest connection, loyalty program.
Yep. They relaunched their SG Rewards loyalty program right at the beginning of April.
And how's that going?
Early signs are strong, they said, adding around 20,000 new digital customers per week. The idea is to make it more engaging, more rewarding, offer things like early access to that new KBBQ menu for members.
Smart tie-in. And the operational excellence part.
On that side, they've rolled out an AI-powered system for workforce management. It's live in most restaurants now.
AI for scheduling. What's the impact?
They're seeing nearly a 10% increase in average weekly hours worked, and get this, almost a 50% decline in absentee rates.
Wow, that's significant. Better staffing, more consistency.
That's the goal. And to help drive that consistency, they've also hired a new chief operating officer, Jason Cochran. He's got experience from Pizza Hut and Chipotle.
Okay, bringing in someone with experience to tighten up operations across the board. Makes sense. So connect with guests, run smoother operations. What's the third pillar?
The third pillar is focused on strategically expanding and evolving their footprint. Basically opening more stores, but smartly.
Are they sticking to their growth targets?
Yes, they're reiterating their goal of 15-20% annual unit growth. For 2025 specifically, they plan to enter 3 totally new markets.
Which ones?
Sacramento, Phoenix, and Cincinnati. And overall, they plan to open at least 40 new restaurants this year.
40 new locations. That's quite a few.
Yeah, and about half of those, 20 of them will feature their infinite kitchen format.
Ah, the automated make line? Are they putting that in existing stores too?
Yes, they mentioned plans for retrofits and even relocating some stores to incorporate the infinite kitchen. They also highlighted that their new stores opened in 2024 are doing really well, on track, hitting metrics early.
And how's the infinite kitchen performing generally?
They said it continues to show strong results, meaningful margin leverage, so better profits, and higher native digital salespeople ordering through their app or website.
Makes sense. It's probably faster and more accurate. What about the Sweetlane, the drive-thru concept?
Also doing well. The one in Schaumburg, Illinois saw over 20% year-over-year comparable sales growth. And its average volume and profit margin are apparently above the fleet average, without much extra cost to build.
So good returns on that investment.
Exactly. Strong cash-on-cash return potential, they said. They're planning 2 more Sweetlane locations this year.
Okay, so expansion continues with a big focus on these newer, potentially more efficient formats like Infinite Kitchen and Sweetlane. Now, something that's been in the news a lot, tariffs. Are those going to hit Sweetgreen?
They are, yeah. Tariffs are definitely on their radar. They're expecting about a 75 basis point impact on their supply chain in Q2.
75 basis points. Where's that coming from?
Primarily from packaging materials they source from China.
Okay. Are they doing anything about that?
They are. They're actively working to move that packaging sourcing out of China by the second half of the year.
And if they manage that?
They expect it'll reduce the impact down to around 40 basis points. So mitigating some of it.
What about building costs? Especially with all those new stores and infinite kitchens.
Yeah, tariffs are expected to increase the build-out cost too, roughly 10%, but mainly hitting later in 2025 because they've already bought some components.
And the infinite kitchen specifically, does it use Chinese components?
It does. Around 15% of the cost for each infinite kitchen unit is tied to components from China.
So tariffs will make those more expensive to build too.
Yes, it will add to the cost.
Yeah.
But they still see the infinite kitchen as accretive, meaning it adds value overall because of the long-term labor savings and the better throughput, how many orders they can handle.
Okay, so short-term cost pain from tariffs, mainly on packaging and build-outs later in the year, but they have plans to lessen the impact and still believe in the tech investment.
That seems to be the message, yes.
So putting it all together, what's their overall financial outlook? What are they guiding for the rest of 2025?
Okay, for the full year, at least 40 net new restaurant openings, like you said.
Right.
Total revenue between $740 million and $760 million.
Okay, and same-store sales. After that Q1 dip.
They're guiding to approximately flat same-store sales growth for the full year.
Flat. And margins.
Restaurant level profit margin around 19.5%. An adjusted EBITDA of approximately $30 million.
Okay. Any other color on the year?
Yeah, they mentioned that most of those 40 new openings, about 30 of them, are weighted towards the second half of the year. And importantly, they don't expect any more price increases for the rest of 2025.
No more price hikes. Interesting.
And they did acknowledge that the softer sales they saw in April, which kind of coincided with all the tariff news, has made them a bit more cautious near term.
So Q2 might be tough.
They basically said expect Q2 to be challenging. However, they are anticipating a pickup in the back half of the year.
Why the optimism for the second half?
A few things. Easier comparisons to last year's numbers, the return of popular seasonal menu items, maybe that KBBQ effect, and the growing impact of that revamped loyalty program kicking in.
Okay, so near-term caution, longer-term optimism based on their initiatives. Did they talk about value at all, with consumers maybe pulling back?
They did touch on that. They acknowledged there might be a price gap, not enough options in the middle to lower price tiers on their menu.
So are they planning like a specific value menu?
Not explicitly. They talked more about using seasonal menu flexibility to offer value and maybe introducing some new core items. The focus is on value perception, not necessarily just cheap items. And they see the loyalty program as a key tool here for offering personalized promotions.
Targeted value through the loyalty program. Interesting approach. Any other regional callouts? Like LA was hit by wildfires. Any other areas struggling?
Yeah, they mentioned LA continues to be significantly impacted by the aftermath of those fires. And Washington, D.C. also saw some change in volume around the start of April. They noted the stores there tend to be older and smaller formats generally.
Got it. What about delivery, the marketplace channel like DoorDash, Uber Eats?
That channel continues to show strength, they said.
Why is that holding up?
Well, they think their product just travels well. It's suited for off-premise. Plus, they've worked on optimizing their partnerships with those marketplaces. And they hope the new loyalty program will eventually drive more people to order directly through Sweetgreen's own app or website native transactions.
Right, try to capture more of that margin themselves. And despite the macro headwinds and challenges, they're sticking to that 15-20% unit growth target.
Seems so. They remain committed to it, saying it's driven by strong return on capital, especially with that infinite kitchen format, even with everything else going on.
Okay, a lot to unpack there. They're definitely navigating a complex environment. Right, let's shift gears slightly. It's time for our This Is Not Financial Advice segment.
Ah, yes, the outrageous but plausible trade ideas.
Exactly. Based on everything we've just heard, what's an interesting, maybe slightly out there, potential trade?
Okay, here's one. We heard tariffs are hitting Sweetgreen mostly on packaging sourced from China, and they're trying to move away from that in the second half of the year.
Right, towards presumably domestic suppliers.
Potentially, or at least non-Chinese suppliers.
Yeah.
So here's the idea. Maybe a short-term long position on companies that are heavily involved in domestic restaurant supply chains. Specifically, maybe those specializing in sustainable packaging alternatives.
Interesting. The thinking being?
The thinking is, if Sweetgreen and maybe other chains are scrambling to shift packaging sourcing out of China later this year, it could create a temporary surge in demand for these domestic, maybe more sustainable packaging players.
A temporary demand spike, but you'd need to be careful.
Oh, absolutely. You'd have to be mindful of the overall economic headwinds hitting the restaurant sector generally. It's definitely short-term and specific.
Okay, that's one idea. Got another.
How about this? Sweetgreen is really pushing menu innovation. We saw the Ripple Fry success, the upcoming Korean BBQ thing.
Yeah, clearly a focus.
So what if you tried to get ahead of their next big hit? Explore a long position in a niche agricultural commodity that might be tied to a future, totally unannounced menu item. Sweetgreen could be testing.
Whoa. Okay. How would you even figure that out?
You'd have to be digging deep, maybe scanning food industry reports for mentions of unusual ingredients they might be experimenting with, like a specific type of pepper or grain, or maybe a unique fruit for a seasonal salad. Something not mentioned on this call, obviously.
That sounds highly speculative.
Extremely speculative. It's basically betting on predicting future food trends and Sweetgreen adopting them and them being successful. Hence, outrageous but plausible.
Definitely fits the bill. Okay, two very different thought-provoking ideas there.
Just food for thought, as always.
Absolutely. And that wraps up our deep dive into the Sweetgreen first quarter 2025 earnings call.
We've covered the key financials, the strategic pillars, the challenges like tariffs and consumer spending, and the opportunities with innovation and expansion.
Hopefully this has given you a much clearer picture of everything shared on that call and maybe sparked some thinking.
Remember, stay curious, keep digging into the details yourself.
We'll be back soon with another earnings deep dive.